I mean, you could say that houses are on sale, 37% off, this year only. But it's funny, isn't it? When cheese goes on sale, everyone buys more cheese. When houses go on sale, everyone stays away.
Yes, that's right.
Right.
Welcome to the LoweDown. This is Wellington's #1 real estate podcast. I'm Craig Lowe, and I'm here with my good friend, business partner, fellow real estate agent and investor, Adam Coburn.
Hey, everyone.
And we're going to talk about the market today, and specifically, I think, is now a good time to buy a house, perhaps from the perspective of first-time buyers and also investors and stuff like that. So, Adam, in terms of the market snapshot, where are we?
Right, there we go, straight into it. Here we are. Where are we? Gosh, we've had interesting times, haven't we, over the last 3 years or so. So the Wellington market peaked 1 month ahead of the rest of the country on average in October 2020. When was it? 2021.
Yep.
We then saw really precipitous falls. We fell by about 26% in Wellington largely over the next 9 months or so, really finished in after 12 or 15 months. Then 2023, we saw some quite good recovery as really driven by a lack of supply coming to the market because the vendors saw that it was extremely hard work out there. Very few people were really forced into selling en masse because everyone had their jobs still. There was good wage growth happening. And so, when they saw the poor results coming through in the market, how hard it was to sell and everything, vendors basically, the way I say it is vendors went on strike.
They just delayed the decision, right?
Yeah, they just put their lives on hold, basically. Now, obviously, you can't put your life on hold forever, but temporarily you can. And so we saw the market was really starved of new supply coming on. There was also talk of interest rates perhaps peaking or getting close to their peak. So buyers saw out there a combination of three things. Number one, rumours that interest rates were perhaps at their worst they were going to get. They weren't going to get any worse. Secondly, market starved of new stock coming to the market, so less choice for them every week. And thirdly, prices have stopped falling. And so that gave them confidence to come back into the market. So the combination of starving of new listings and buyers returning with confidence started to bring some good results through.
So there was another really interesting thing that happened late last year, and I agree with everything you just said, but there was another driver, and of course that was the election, right? Do you remember what happened before that?
Yeah. As is often the case before an election, anything which is in the near future, which brings uncertainty, freezes people's decisions, doesn't it? And it's strange because when I talk to people potentially, thinking of selling, they say, I just want to wait to see what happens in the election, right? And I say, what happens if there's a Labour-led coalition comes into power? And they go, we definitely need to sell. And what happens if a national-led coalition comes to power? Well, we definitely need to sell still. So it's like, regardless of what's going to happen, but nonetheless, that's what happens. People put their decisions on hold, and then when the election's out of the way, then the vendors come back to the market in droves, and that was accelerated or exacerbated, I suppose, because decisions had been put on hold for 12 to 15 months before that. And so then we saw this incredible increase in supply and new.
I mean, it really was phenomenal.
Massive.
A huge increase in supply. Now, we might actually be able to fire up a graph onto the screen during this podcast, which will, is really instructive. But it was amazing to see the lack of supply just driving the prices up by 2 or 3%. And it was like when the media started to get hold of the fact that prices were going up again, it was like it gave everyone permission to come out of the woodwork, right? Plus, of course, there was a
and the ability to sell.
Yeah, that's right.
Because a big risk is like, am I going to even affect a sale? How long is it going to take? Because it's stressful if that's happening, right? You mentioned 4%, Craig, but it was more like we went from 26% below peak to 20% below peak. Yeah. That sounds like 6%, but it's more like 8% once you go from 74%.
True. Yeah, it was a big jump.
7 or 8%. Yeah.
And the deep irony, of course, is that the best time to sell in that 6-month period was actually when no one else was, right?
Right before the election.
Yeah. Yes. Exactly. And so, like so many things in life, if you are going to make decisions, you want to zig when other people are zagging.
Yeah. Swim against the tide. So you mentioned the big increase in the stock levels after the election. So I remember in Wellington City, that's Tawa to Seatoun, that territorial authority we had, I think it was about 465 listings on Trade Me in that TA. 6 months later, we had 920.
Yeah.
So almost literally to the point, a doubling in overall stock levels in that 6 month period, which is just absolutely enormous. Now, the whole country saw that general trend, but nowhere saw it more than Wellington.
Wellington was extreme. Yeah. And so obviously things changed this year, right? We had that big increase in stock. Prices started to perhaps drift down a little bit. But of course, there's a sort of an interesting counterintuitive thing here, or sort of a bit of a paradox, in that we had a 50% increase in supply. So year to date now, as of today, stock levels are up 50% on the same period last year, right? And yet 20% more houses are being sold, right? So 20% more are also, so more turnover is happening, yet prices have been tracking down.
Yes, that's right. Yeah, because it's a balance of supply and demand. So
Exactly.
you've got a few more sales taking place, 10-20% more, like you say, but from election to 6 months later, we literally had twice as much stock. So I was saying to vendors, look, yes, we're making more sales, but if you look at one listing, each one listing seems to be way harder. Yeah. Because you got twice as many of them for only a 10-20% increase in sale volumes. Yeah. Because at the same time, of course, when the new government came in, change of government, change of kind of sentiment, a whole lot more uncertainty introduced to the public sector labour market. So whilst you had this flood of new stock coming to the market with vendors encouraged by the positive results of 2023, finally I can take my lives off hold, get on with my lives again. Then you have the uncertainty in the buyer market, in the labour market, having buyers pull back. So you got this increase in vendors coming to market and this pulling back on the buyers. So naturally you get a whole lot more difficulty, trying to compete for buyers' attention and getting commitment from buyers.
What's your opinion on interest rates? I mean, obviously there was a lot of talk late last year, which ended up being incorrect, about how quickly they were going to come down this year.
Yeah.
So higher for longer seems to be a definite theme this year.
And that just carries on, doesn't it? It's like, yes, we think we're going to be higher for longer. We think we're going to be higher for longer. We think we're going to be higher for longer. It's just like I remember there was a lot of commentators who thought perhaps interest rates might come down end of last year. Well, that obviously hasn't transpired. Now people are talking about November, right? Neither of us around this table know, right? That's one thing for sure. We can have our opinions, but certainly the consensus seems to be November. Generally, the consensus also seems to be that the Reserve Bank, they always go too far in both directions. So they printed way too much money. They stimulated the economy with interest rates that were way too low for way too long. When they came out of that phase and they recognised that they had overstimulated, they had to increase interest rates, tripling of interest rates in 18 months. I mean, that is a massive change. And anyone who was bearing a lot of short-dated kind of debt, I suppose, really would have felt the brunt of that. So what's going to happen now? Well, I think there's no doubt it's going to come down, right? The only question is when, by how much, and how quickly. If history repeats itself, and as we know, history doesn't repeat, but it does tend to rhyme, the Reserve Bank will realise, gee, we've gone too far, and we'll have to backpedal quickly. So certainly the economists that I pay most attention to, they're all suggesting that when it does happen, it's probably going to happen steeply in the same way that it happened steeply on the upwards direction coming into this phase of the cycle. Yeah.
And in terms of your first-time buyer now, I mean, from my perspective, we can see that segment of the market is the most active. Right? Would you agree with that?
Yeah. It's quietened down a bit, I think. In recent months, it seems to have just quietened down slightly, but still most active. I agree. Yeah.
And so if you're a first-time buyer today, if you're talking to a first-time buyer, what would your advice be to them in terms of should they buy now? Should they wait? What's going on in the market for a first-time buyer?
Yeah, I mean, the most important consideration, I think, is your personal situation, your personal circumstances, right? But if you're trying to time the market is a fool's game, right? That being said, if someone is thinking, I'm going to delay my decision till later because I think the buying will get better, I think that's a bad decision. It's possible, of course, that prices could continue to pull back. They've pulled back by several percentage points in the last 3 months. Is it possible that they pull back a bit more? Yes. Is it likely they're going to pull back by more than 5%. In my opinion, no, that is not going to happen. And what I would suggest is, instead of thinking, when can I buy to absolutely perfectly time the absolute bottom of the market, I would more think of it like, I have an opportunity now where there is less houses being transacted, to have better choice, get more of my boxes ticked for my budget. Try and focus on getting the best house I possibly can now, when I've got more power in the market, more leverage in the market.
Well, there's a lot more stocks, so slightly more houses being transacted, but a lot more choice.
A lot more choice out there.
So that's a good thing.
Use the opportunity to a buyer in the market, a good quality buyer in the market now is more valuable than it often is. So use that leverage, if you like, that bargaining power to get a better house than you would otherwise be able to get for your money. And that way you probably can stay in the house for longer. Changing properties is expensive, it's very stressful, it's time consuming. Yeah.
And what about timing in terms of value, right? Like, I mean, just in terms of, how much you're paying versus what you're getting. I mean, I've seen some graphs showing that we are below the long-term trend now in terms of property prices in Wellington. Yeah. Do you have any comments on that?
Yeah, well, I mean, Tony Alexander produces a good series of graphs where he analyses the typical or the average value of a property in a different location, as a function of where it normally sits compared to nationwide averages. So if something is above trend, then it's overvalue compared to where it normally sits nationwide. And Wellington City, and to be fair, the same is true for Auckland City, are about the most undervalued markets in the country at the moment. So on that basis, certainly you suggest that Wellington City, and it's not necessarily the same for the other territorial authorities in Wellington region, the Kapitis, the Hutt Valleys, the Wairarapis and so on. Wellington City in particular seems to offer the best value. I mean, obviously, prices in the city, like I said before, were down 26%. They recovered to down 20%. They're now back down to 24% down. So 24% reduction in values, nominal values that is. Over that period of time, we've seen wage inflation.
Yes, you made that point yesterday. It's a great point.
We've seen wage inflation over that period of time. Gosh, it must be 12, 15%. So if you add 12% to 24%, that's 36, 37, 38%. I can't recall the exact numbers on wage inflation, but that's 36 to 38% reduction in real house prices.
Yeah, and that's a great point, because right now people look at this inflation and they're saying, well, going to the supermarket is so expensive, and I'm buying less, and that's correct. But in the housing market, that wage inflation and the prices going down is actually so wage inflation has been a positive thing for people buying houses today. Of course, you have to be able to afford the outgoing, right? So the interest costs are high right now.
Yep. So yeah, I mean, you could say that houses are on sale. 37% off. This year only. But it's funny, isn't it? When cheese goes on sale, everyone buys more cheese. When houses go on sale, everyone stays away.
Yes, that's right.
Right. It's so counterintuitive.
Financial markets are, of course.
There are a lot of reasons for that too. I mean, real pragmatic reasons. One of what you just mentioned, which is the actual affordability given by interest rates. Now, of course, affordability is not just interest rates; it's the prices as well, and the wages, and so on. So again, I don't have those numbers exactly in front of me in terms of it like an index of affordability, and those measures are produced out there. But yeah, the hard thing, of course, is your ability to get finance, and if you can get the finance, the interest rate. You've said many times that you don't marry the interest rate, you marry the property. And what that means, of course, is regardless of the point in time that you buy the property, in 5 years' time, you're paying the same interest rate as everyone else. Yes. So the high interest rates now, yes, they're painful, but in 3 years' time, you'll be paying the same interest rates as everybody else.
Exactly.
So if you can bear the higher ongoing costs of those.
As a general rule, it's probably better to buy when interest rates are high.
Yep.
As a general rule.
If you can afford those repayments in the short term.
Correct, because the prices can be lower. I mean, it's a counter-cyclical sort of approach, right?
So obviously, don't buy something that you can't. That's going to put you under. And make sure you can afford the cash flow. And of course, there's a certain amount of belt tightening that most people can do. Stop buying takeout food, stop going out for meals, just cut back on those more discretionary expenses in the short term for a longer term gain. Because the difference in your repayments might be $10,000 or something, but the difference in the value of the house might be $100,000.
So I've got a theory for first-home buyers that will run past you, something that my wife and I did years ago specifically, and it's related to...
You're not normal though, Craig, you know that, don't you?
No, that's true. But and we can talk about the investors. We've talked about first-time buyers. We can talk about investors as well, because I think that'd be really interesting. We'll come back to that. But to sort of combine those themes, if you look at the market right today and what people have to pay to buy a house and what you can rent a house for, there's sort of a term for this which is called rent vesting, where instead of actually buying a first home to live in, you save your deposit and buy an investment property. And you rent while you still own a house, but you rent the house out, right? And to give some ideas around the economics of this, you can often have a better lifestyle when you rent a property, right? You could potentially rent in Mount Victoria for $1,000 a week, and an average house price might have $1,000 a week mortgage these days, right? So you might be able to live in a suburb that's typically more expensive than you can afford. But more importantly for me, I find this really fascinating, is I watch people buy houses. And they sort of think about them as a lifestyle, but also as an investment. The issue there is, once you own a house as a first-home buyer, suddenly you want to upgrade it. You've got rates, insurance, you've got maintenance, everything's falling apart around you. You want a flash kitchen, and actually the emotional side of owning a house is actually much more expensive than you thought. You want to make a home or nest there, and so delaying those sort of desires and those costs, for as long as possible. Whereas you can actually buy today, say a 2 or 3 flat property in Wellington, as you will know, on yields, that's the cash return that we haven't seen for maybe well over a decade. I mean, it might be
long time,
15, 16, 17 years since we saw over 7% return. And so my view is that, again, I know there are some issues around financing because the deposits tend to be higher that you need, but removing that hurdle. And again, speaking from some experience here, because my wife and I did this, we actually rented for 5 years and had some rental properties, and that was a great thing to do. We lived in Mount Victoria, we had a great place in Scarborough Terrace, which we really loved, but we weren't so emotional about it that we wanted to, renovate the kitchen and spend all this money. And the investment properties we had eventually allowed us to get back into the market when we sold them
buy something much better than you would have.
That was more of a family home that was suitable for our family. So what do you think about that?
I mean, I've never used the term rent vesting, and I've seen it being reported in the media maybe only in the last 6 months or so. And to be honest with you, I mean, I think it's such a smart way to go. The first property I bought was a 3-flat property in Adams Terrace. I had these visions of owning the whole street because, of course, my name's Adams Terrace, then it would literally be my terrace. But that never happened. But so I did exactly that. And I've said that because I think it's such a smart idea. It just makes so much sense. You can rent a nice home way cheaper than you can own it, especially when the interest rates are high like they are now. And coupled with the fact that the rental market is actually quite soft. So it's really quite difficult now, way more difficult than it has been for some time, to find good quality tenants. Rents have dropped for many places. So the formula is more true now than it has been for a long time, I think. To be honest with you, I've just given up trying to suggest that to people, because as soon as I start talking about that sort of thing to people, their eyes just glaze over. And because what they want is the typical thing that everyone wants, which is the what do you call it, like the chocolate box villa, the cute villa on the front with the dog and the picket fence and the pretty flowers and the single garage in the backyard. They are not thinking from a financial standpoint. They are completely, they're making the decision completely emotionally, which is totally fine. But the frustrating thing is, you probably find the same thing, that they convince themselves that it's financially smart. It's actually their emotions driving it, which is fine. And you and I have talked about this yesterday as well, that that's all good as long as people are honest with themselves that they're making this decision emotionally rather than convincing themselves and persuading themselves and tricking themselves that they're making a smart financial decision.
Emotion is not the antonym of rational.
No.
You can do something for your emotional self, and that can be rational, but the key is being purposeful about it. It's when your emotions drive your decisions and you think that you're doing it for a different reason that's the problem. And we do see that a lot in this game.
So I can't recall ever, I don't think. I've been selling real estate since 2007. What's that, 17 years. I can't think of a single example where someone's done that. And they all just want to buy the cute 2-bedroom house in city fringe suburb or whatever. But I think it makes total sense.
And so obviously one of the big reasons, it's probably worth pointing out, one of the reasons that equation is in favour of, like, say, reinvesting right now, or even just investing in investment property right now, is of course because multi-flat type pure investment have higher rental returns than a single family home.
Much higher.
Which I think is an important point, because you can't just buy a single family home, rent it out, and then and get the benefit of this.
No.
You have to buy the pure investment property, which wouldn't suit a family to live in.
I mean, it's quite conceivable that a multi-flat property, 2 or 3 flats. I mean, 3 flats gets harder to finance. 2 flats is easier. Home and income. I like if I'm buying an investment property to buy a property where there are multiple exit strategies as well. So I'm not locked into just selling to an investor. So I could potentially in the future sell to an owner-occupier as well, like a home and income or something like that. Anyway, we sort of digress, but it's quite conceivable, I think, now to buy a property. Let's say if you had $1 million budget, you could buy a property for $1 million that you would be happy to live in, and it might rent for $900 a week, $1,000 a week. Or you could buy an investment property for $1 million, and it quite conceivably could rent $1,600, $1,700 a week.
Yes, exactly.
So that's $600-$700 a week that you are better off, but you still get to the comfort of living in the house that that would only rent for. You rent it for $900.
Yeah. You're getting a better deal than the landlord is.
That's right. That's right.
Yeah, to rent a family style home right now.
And of course the difference is also we're sort of in a market of 2 halves at the moment. Well, it's not halves, but two segments. The investor stock, by which I mean, like you said, the classic investment property, the 2 flats, the 3 flats, city fringe locations, that sort of thing. Maybe more bedrooms, less living rooms, that sort of thing to crank the income up. Those properties are profoundly out of favour simply because investors really, the business case for being an investor has been crushed. Out of all existence over the last, really the nail in the coffin was in March 2021, wasn't it? March 2021, when the previous government
interest deductibility.
Yeah, removed interest tax deductibility. Everyone, the bit that was in the headlines was the bright line test being 10 years, but that was neither here nor there really for true investors. It was the lack of ability.
Kills the cash flow.
Yeah, that's right.
So question on that, because that's a great point, and I think it's a great segue into this investment market, which it really is the weakest. I mean, we're seeing that dramatically. I mean, in 24 years of being in the real estate game, I've never seen a time when there's less investors out there, and it's phenomenal. And I would never have been able to guess if you'd asked me 15 years ago this would ever happen. I just would never have thought it would have.
Well, who would have thought that you would you disallow the ability for a business person or a business to not claim the biggest business expense as a legitimate business expense and call it a tax loophole?
Doesn't seem very fair, does it? So now, but these things are changing, right? So here's an interesting thing. I get this question a lot from people. People are saying, well, look, national government got in. It's got to be good for property investors, and of course, a lot of these things are now actually unwinding. So from my perspective, I'll give you my take on it, and that is, seems like there's a really interesting demographic kind of shift going on here, where which may be quite structural or a sort of a long-term thing, and that is that baby boomers really are now entering retirement age, or if they're not already retired, they're sort of, and there's a big wave of that happening, and so they tend to be more net sellers rather than purchasers of investment property. They don't have 10 or 20 years to let an investment property do its thing and build wealth anymore, right? So they tend to be net sellers, and a lot of them are just fed up with the cash flows not working right now, right? I've experienced that as well.
It's hard work.
If they were living off the cash flow and now it's not so good. So there's that, and then of course you've got the new generation coming up, and I find, this is a very general statement. It won't be true of everybody, but I find there's a kind of almost a negativity around being an investor. Sort of the kind of
Oh,
greedy,
profoundly unfashionable.
greedy landlord, the sort
on
of
the pig's back.
of side of things. So that seems to be affecting the kind of demand side a little bit, and people are just not interested in it. So that to me seems why we're kind of got this malaise, even though a lot of those things are unwinding, and that is of course, for the sophisticated investors that have been doing this a long time, that's the opportunity, and also that sort of reinvesting thing, if people could get their head around that really is what's creating that opportunity. Would you agree with that?
Yeah, I mean, whatever the drivers are, I suppose, the result is that investment properties are very difficult to sell at the moment. Therefore, if you are looking at longer term, obviously if you are buying a property as an investment, you ought to think long term, minimum 10 years. Yes, the net result is you can make these purchases at significantly lower prices and higher yields than you would otherwise be able to do. And of course that's in an environment where in fact the rental market is soft, so rents are comparatively low. I mean, if you actually graph rent as a function of household income on average, in Wellington it's been dropping. Now that might sound totally counterintuitive, but as incomes have been going up, all other prices have been going up, rents have not been keeping pace with inflation. So as a result, the proportion of household income that's been used up in rents in Wellington has been falling away. It's not the same across the rest of the country. Wellington market has been unusual in that regard. But yeah, the result is you can buy an investment property at higher yields than you have been able to for a long time, which makes it easy to hold for a long time. Lower prices and with far less competition from other buyers. The challenge I think you've got at the moment for the people who want to do that is there aren't that many on the market because people know it's hard to sell. So only the ones that are really serious about selling are on the market. Is that changing? I'm personally seeing more activity from investors selling. Not more activity from investors buying.
I know.
Definitely more activity from... Most of my listings this year have been investors selling stock. The likes of, say, Tony Alexander again, he does his surveys and that shows that more investors are thinking of selling. Feedback from mortgage brokers and real estate agents around the country is more investors are making inquiries, getting appraisals. It certainly seems that way, yep.
So good time to buy investment property.
Good time to buy
as a first-time buyer as well. So what about upsizing, downsizing? So it's a slightly different calculation there, right? If you own a house, I mean, it's a big portion of the sales that happen, right? Huge part of the turnover is being upsizing and downsizing, and we know that those people have also been putting off their decision in the last 2.5 years, right? So what comments you got on upsizing and downsizing in this current market? I
mean, I think the main thing is that when's a good time to be an upsizer or when's a good time to be a downsizer? Well, when your life circumstances suggest that it's the right time. The truth is, I suppose, that whether you're upsizing or downsizing, if you're buying and selling in the same market, it doesn't make a lot of difference. If you really want to get technical, if you're a net investor, that is, you're upsizing, you're going from a $1 million house to a $1.5 million house, you're a net investor by $500,000, you're better off doing that when the market is depressed. It would be a mistake then to fascinate on the fact that your house that was worth $1 million is now worth $750,000 and think it's a bad time to be an upsizer.
Yeah, we see people making that decision, right?
We see it all the time.
Because they can't get the price, they're anchored to a price from a peak sort of
right.
level.
Now, in some situations, that logic is sound because they might have debt of $600,000, and so the house that was worth $1 million is now worth $750,000. They've gone from 400 equity to 150.
Depends when you bought, right?
Yes.
That's the key thing.
But if you bought some time ago and the amount of equity that you will release once you've paid your debt off is not constraining your next move, then no question about it, being an upsizer, being a net investor is better off when prices are low. If you have choice, therefore, do it now. If you're downsizing and you are a net seller, you're going from a $1.5 million property to a $1 million property, then obviously you want those prices as high as possible because the difference between the two is bigger when the prices are higher. But that being said, how do you know when this is going to change? When a price is going to go up? How long? And then when we came out of the GFC, prices in Wellington, nominal prices in Wellington, were flat for 7 to 8 years, or almost flat, 7, 8 years.
Yeah, it could be a long time. People don't. I don't.
Is it going to be the same this time around?
Yeah.
Who knows?
Yeah. So a summary on that would be really if you're upsizing to a bigger, better house, a fantastic time to do it.
Unquestionably.
And mark to market on your house, like find the market price, sell it, and you're buying something in the same market, you're actually getting a better deal on your upgrade.
Great time for upgrade.
But generally speaking, more generally, if you're buying selling in the same market, if you're upsizing downsizing, don't worry too much. Personal circumstances, just go for it.
That's right. Don't put your life on hold trying to predict when the market is going to...
Short term, you can't, no one knows, right?
Yeah,
I agree. And so looking out for the future, right? Like we take out, 10, 20, 30 years or so. It might be going a little bit far, you've got a good...
We've got a crystal glass here. I don't know if it's a crystal ball, but...
So one of the things that has been really interesting, well, actually, let's go into the past. We take the last 40 years. There's been a huge increase, this massive increase in property prices, right? I think a 7% compounding roughly over 40 years, massive, right? And then you look at the secular decline in interest rates that we've had from, as high as sort of in the 20s.
18%, 20%.
Yeah. And a huge part of that increase is probably related to that cost of capital coming down so much and asset values increasing. We now are in a situation where the bank's not going to probably pay you to borrow. We're not going to go down to a minus 5% interest rate, right? No. So cycle. We'll probably still have these cycles through time because of the way underbuilding now. Like developers are not active. They're going to underbuild over time. Population growth, interest rates will come down. Those fundamentals will set up the next cycle.
As long as there are human beings involved, you're never going to get rid of cycles.
Yes, the human nature will drive the cycle, and then but perhaps as a speculation for you, you think the cycles perhaps might be a little bit. One way to put it might be that we might beat inflation compounding by maybe 2% rather than the 3.5 or so that we have for the last sort of 40 years.
Yeah. I mean, you just can't argue with that logic, can you? That in the 1980s we had interest rates that were 18%, 20%, and as of a couple of years ago we had interest rates that were 2.5%. So we've gone, even if we said we went on average from interest rates from 15% down to 5%, you're just not going to go from where we are today. That's a dropping of 2/3. If average interest rates now are say 6.5%, we're not going to drop 2/3 from 6.5 on average in the next 30, 40 years down to 2.25. So that has to be this huge tailwind that we have had in the last 40 years that we're just not going to get in the next 40 years. Now, of course, do we know that for certain? Of course not. But that's where our money is. So there would have to be all these other factors driving prices to continue to go up at the same rate that we've seen in the last 40 years in the next 40 years. Is it possible that these factors come to bear? I guess it is, but I don't think it's likely. No.
Okay, no, I think that's fantastic. That makes perfect sense to me. And
from an investment standpoint, Craig, I think that's a good thing. As an investor, more people should be focused on
cash flow.
The cash flow of it. But that's how any business person thinks. Yep. It's about the cash flow and actually
speculating on massive capital
gains. Exactly, that's dangerous, and it's not good for the country for house prices to continue to go up and up and up. Yep. So if it stops speculators and long-term investors focusing so much on the capital growth, and it has them focus instead on the net cash flow of the asset in the same way that a buyer of any other asset or business should be focusing on, in my opinion, that will be good for the health of the
a much more rational market, and hopefully cycles that don't lead to bad human outcomes where people just can not afford to get into the market. Right?
Exactly right. So going from speculators that think they're investors to actual investors. Yeah.
Well, I think that wraps everything up. I really appreciate it, Adam. That was awesome, and that was the lowdown. So would be amazing if you'd subscribe. We'd love to do this again. We're going to give you some great insights, great speakers, and look forward to doing another one.
Thanks a lot. That was a lot of fun.